Good morning. I'm Andrea Burroughs and I work for Guaranteed Rate. I was considering doing a commercial, but I just can't seem to do it. So I'm going to go with talking to people one-on-one because that's really what I like better. I do want to go through a couple of things with all of you guys just to let you know how it works. And then I'm going to give you some ideas on conversation tips to listen for if you're ever looking for you know what, we'll get into it. So let's just get right into it. So the rates, let's talk about the elephant in the room. The rates are going up. It's inevitable. They're not going to skyrocket. It is all relative. It is something that you really should think about. Back in 2002, when I was doing mortgages, the rates were easily in the 8s. And then they came down to 7. And everybody was crazy because they came down to just above 6. And then they came down to 6. So to say in today's market that it's unbelievable that you're going to have to pay 4% on a 30-year fixed rate is I understand why people are upset. It is inevitable. That's the way the economy works. And, you know, there's always another plague to help draw the economy down, but let's not hope for that and go with the 4%. Owning a home is a tax benefit. You do get to write off your mortgage and interest from your income tax at the end of the year, which is why a lot of people even start the home buying process. And in today's housing market, it seems that a lot of people are looking for space for very obvious reasons. The pandemic kind of drew a lot of people away from the more condensed urban areas where everything was right at their fingertips and into an area where they could create a life for them and their families or their potential families or their extended families as their aging parents. You know, there's so much havoc going on in nursing homes. They want to protect them. They want to take care of them. And it's kind of a return to the old way where they just want to be able to have their own personal area to do that. So why do I do mortgages? That's always a good question. There's a lot of people who think that mortgages are just about, when I was first in mortgages in the early 2000s, a lot of people assumed that we were like car dealerships. Now, my husband's in the car business, so I can say this without any kind of bias. Car dealerships are notorious for looking to just make a lot of money, but there's reasons for that. It's not just about the income, it's also about their inventory. I don't do this for any other reason than I was the product of a single parent and I grew up in apartments my whole life. And when I got the opportunity to help learn how to put people into their own homes, that's where my passion spiked. I was in college and I decided that I wanted to be able to do this for people. And it's amazing. It's a much more arduous process than that. I, quickly learned that my naivete was just based on thinking that 4 walls and a roof to call your own was the end of it, but it's not. So let's talk about what you have to do to qualify for an income. Now, a lot of people have been on benefits for the last couple of years. Unfortunately, we can't use those benefits as income. Even though the primary need for your income base is usually 2 years of earnings, we can't use unemployment income, but we can use Social Security income. If somebody has maybe turned to early retirement or even early partial retirement, we can use their pension funds. We can use their interest income. It really just needs to show that it's been consistent for the last 2 years. So being a W-2 employee is not the only way to buy a house. You can also be self-employed. The government is very aware of some of the tax benefits that people have when they are technically self-employed, even if they are not, or 1099. But that comes down to what your federal income tax return looks like. And it's not always black and white as to what you see on your income tax return. I have to dive into it. I have to look at a Schedule C. I have to look at other schedules to see what you've written off and what qualifies as income. And then we can qualify you for the house that you can afford. My main concern, and especially after 2008, the federal government had a lot of overhaul and sanctions, not sanctions, but I'm thinking of the Ukraine, pardon me, the overhaul of what we were allowed to do as lenders. One of them is making sure that that file is complete from beginning to end. So maybe Erin is a multimillionaire, but she doesn't show it on paper. How exciting would that be, right? If I can't prove it on paper, unfortunately, the government is going to come in and they're going to audit us. They're not going to audit Aaron. They're going to audit the mortgage company, and they could fine us for giving somebody a mortgage that on paper says they can't afford it. So it's much more complicated than that. The other thing that you run into in the state of New Jersey is taxes. The property taxes make so much of a bigger difference than you would think in the amount that you can qualify for, even less than what the mortgage amount is. You got to think the property taxes are divided up over 12 months. That's a bigger hit than a mortgage that's divided up over 30 years, 360 months versus 12 months. So that's why you need to know your mortgage rep. Yes. Can you go online and get a mortgage pre-approval? You sure can. Can you get someone on the phone to help you figure out if the extra $5,000 in property taxes is going to allow you to qualify? Probably not. We are local. My office sits in Madison. I do go there. I like to meet the people. I like to see them in person, but almost everything is done online. So I will have conversations with people. They're usually about 10 to 15 minutes, anybody that you refer over, and we'll figure out what it is that they're looking for. Do they need cash out to look at an investment property? Do they need to refi their existing mortgage and just lower their payment a little bit? That's another reason. It's not always about rate. So rates might move, but it's not the only reason that the market keeps going. Ideas to listen for conversations. Somebody's talking about how they might be thinking about relocating, but they don't want to do it yet. That's someone who might want to refinance their house to put some cash aside. If somebody's talking about maybe buying a second home in a warmer state because they don't like it when it's 12 degrees outside, that's somebody who's going to cash out on their existing home. If a home equity loan, which is different from a first mortgage, makes more sense, I'll tell them. I will guide them in that direction. I have to, by law, do what is actually to their benefit. So other things to listen for is somebody who maybe is looking to buy a home that has a bigger area or move into a place where they have more yard space. The big question now is rentals. So let's say you're buying a house that's currently for rent. There's a tenant in there. One of the things that we've been working on is making the closings more strategic. So you might have to close for your rate lock within 60 days, but there are certain lenders that don't require that the new owner take occupancy for an additional 60 days. So now you're talking about 4 months where the tenant has time to find another place to live. Or even the seller. The sellers, there's no inventory. Ask Aaron. It's like digging for clams. You've got to try to finding the right home isn't the question anymore. Can you find anything that you're going to fit into that, is still affordable, that you're not going to massively overpay for? Mm-hmm. It's a hard job that she's doing right now. On my side, mine is to kind of make sure that they know that Aaron is working for them. That their realtor is on their side, because none of us make any kind of income until they actually close on that house. So there's a lot of pre-work that goes into it. And the other things that we were talking about is people who are buying additional homes with the idea of moving, but they don't necessarily want to move yet because they want to sell and then rent so that they can get rid of, technically New Jersey doesn't have an exit tax, but we all know that there's a little something if you're leaving the state right after selling your home. There's a million reasons that people need us. There's a million reasons that they should at least have that conversation with us. So if you are at an event and someone's talking and you are talking about reducing their business income and they bring up the fact that they want to relocate or find something else to go to so that they can have some sanity during the cold months here, think of us, think of me. I'm Andrea Burroughs and I work for Guaranteed Rate. Mm-hmm.
Got a quick question for you. What is the biggest issues that you're seeing right now with Schedule C and individuals areas? Obviously, I always try to coach my clients about, well, that's great, and we can really reduce their taxes. But you got to remember, when it comes time to collect Social Security, when it comes time to get a loan, have you thought about these things? And then we look at that as part of the projections, like where do you want to be when for doing it? But what are some of the, any advice or anything you have for Schedule Cs or things that, I should be looking out for with my clients and how that's changed recently?
So the expectations seems to be the biggest issue, Dennis. The expectation that they can show a year's worth of income, maybe on, line 31 of their Schedule C or line 32 of their other schedules, that they're now showing enough income. You need to have at least 2 years, especially if you're self-employed. I have programs where if you come to me and you're a W-2 employee, we might not even need a tax return. The second you own more than 25% of that business, they're going to want a full federal return. It doesn't matter how many umbrella companies you have over you. They are aware that you're now fully responsible for a partnership property that's in Englewood that's $80,000 in taxes a year. That's having the plan in advance, not just assuming that you're going to do it for 1 year. You're going to pay your dues and you're going to pay your taxes. They have to give it at least a full 2 years. They're going to ask for every schedule in that federal return. They're going to ask for every business schedule if they, are an LLC or corporation. And that's where you want to show the income. So after all the write-offs, you need to show some adjusted income all the way up the bottom of that Schedule C. I think it's line 31, but if I had a form in front of me, I'd be able to tell you more certainly, but that's what we're looking for. And I think that, I'm a roofer, I'm a construction person. I build properties. I make a ton of money. I don't doubt it, but unless that line shows it, there isn't much the banks are going to be able to do for you.
Right. And how has COVID impacted that as far as with the subsidies and different pieces? So what are they doing in the makeup session of, hey, in 2019, I was crushing it. I did what I had to do. 2021, I'm starting to come back, but 2020 sucked. How are people doing that?
That's a great question. That isn't one that we do often run into. So we had one instance where that happened, and we actually showed 18, 19, and 20 to show. And then if you have something, even if it's not an official tax return that you're filing for last year, we'll take that. We'll take 19, 20, and 21 just to show that it was legitimately the pandemic that affected their business. And they know that. So as long as they can show an additional year before or after, they'll make it work. We can make it work.
Andrea, if someone's considering refinancing, is there a magic number as far as how much you're going to save or pay, save per month that people should look for when they decide to refinance?
So the rule used to be at least 1% difference in the rate.
Okay.
That doesn't really apply anymore because more people are strategic about the reasons that they're refinancing. Is there well, let's be honest, if I give you a 30-year mortgage, your payment's never going to change. Now you're paying into it for 10 years, but somehow your payment has gone up because your property taxes have gone up.
Okay.
So it's really an individual reason. If they want the payment that they had when they first took the mortgage out, I can help them get there. If they want to reduce the amount of time that they have left on their mortgage and the overall interest that they're going to pay on their home, I can help them get there. There's no real magic number anymore. I would say anything that is going to achieve what their goal is. And that's kind of the conversations that we're having. What is it that you're looking to achieve? It's an open-ended one, and we go from there. Can we help them or can't we?
So if their goal is to pay less on their mortgage per month, what depends is if the property taxes went up, that could neutralize that actual savings.
It absolutely could.
Later.
It absolutely could.
Okay.
Especially in New Jersey.